Annenberg Media.
When exchange rates gyrate, when investment capital flees the country, when inflation becomes hyperinflation, governments clamp on controls. Exchange rates, capital flight, and hyperinflation. What's their message? We'll find out when we look inside the global economy.
In this segment of Inside the Global Economy, we're going to be talking about exchange rates, capital flight, and hyperinflation. And we'll also discuss the important interaction between exchange rates on the one hand and a country's balance of payments on the other hand. We'll also look at what theories have been developed by economists over the years to explain this important interaction. To illustrate some of these points, we're going to look at two case studies, one in Mexico, the other in Argentina. And we'll also hear from a panel of experts that will focus on some of these key issues. But first of all, let's define some terms. What do we mean by a country's balance of payments? Well, the balance of payments is the record of a country's interactions, economic interactions and transactions with the rest of the world. What comes in terms of money into an economy because it sells goods abroad or services abroad, and what goes out because it buys services and goods from abroad. Let's take a look at a hypothetical balance sheet in terms of a balance of payments account. Again, this is for a hypothetical country, but it helps us to illustrate some of the points here. There are three basic sets of transactions that are measured. The first is pretty easy to understand. It's trade, imports and exports. Exports are goods, let's say, that the U.S. sells abroad. Imports, goods that it buys from abroad. And the difference between those two is the trade balance, as it's called. It's a trade deficit if we buy more goods from abroad than we sell abroad, so that's called a deficit. It's a surplus if we sell more goods abroad than we buy from abroad. The second category here refers to trade in services, and this has two different components. One component might be represented, for example, by a foreign student coming to the U.S. and, in a sense, buying a college education. That is money coming into the U.S. for educational services. It's a very large transaction, as it turns out, because there are a lot of foreign students that come to the U.S. So that's one example of services that we export, in effect. Another is, let's say, if a U.S. company is earning profits in Germany and brings those monies back to the headquarters, that's also a service, if you will, export of a kind. It's exports of capital and earnings on those capital that come back to the U.S. So that, too, is an important category. And it turns out, actually, that while the U.S. has run a trade deficit in terms of goods, we've actually run a surplus in terms of services over the last 10 years. And then finally, there's a third category of transactions which look at investments abroad. These can fall into at least two categories. One is direct investment, where a U.S. company, for example, is buying or building a factory abroad. That's referred to as direct investment. And a second kind are loans, either short-term or long-term, to a foreign country, either an official loan in the sense of it's a government loan or it could be a private loan. Now let's take a look at this important interaction between the exchange rate and the balance of payments, or the current account balance. And let's look at it in three different kind of worlds, as it were. One extreme, in a world of fixed exchange rates, when exchange rates cannot change, then anything that occurs either in the U.S. economy or in the global economy is going to be reflected in a couple of ways. One, in the balance of payments, and secondly, let's say if we have a balance of payments deficit, in losses in reserves from the U.S. abroad as the authorities try to keep that exchange rate fixed. So the point being here is that all the adjustment in a world of fixed exchange rates is occurring in the trade balance or the current account balance or the balance of payments on its broadest basis. Now, if we look at the second extreme, in other words, we look at the other side of the spectrum, in a world where we have completely and freely floating exchange rates. In this world, it's the exchange rates that will absorb a lot of the shocks and reflect all the changes that are occurring in the macroeconomic picture of the U.S. or other countries around the world, or other changes in competitiveness that may be going on. So in this world, and it's an extreme case, the adjustment is primarily on the exchange rate. Now the reality is that in terms of what goes on day to day, we're somewhere between these two extremes. We're in a hybrid world, one in which both exchange rates on the one hand and the trade balance on the other hand do reflect all the changes occurring in the U.S. economy and in the global economy. Let's see if we can illustrate this a little bit further by looking at some flow diagrams that will help us to hopefully see this a little more clearly. The first two sets of flow diagrams will look at how the economy adjusts to an imbalance in our trade accounts under fixed exchange rates. First of all, what if we have a balance of payments deficit? Well, this gets reflected in two ways. The first is that more goods are being bought from abroad, so more dollars are going outside, than are being sold abroad, the more exports being sold to other countries. So there's a net deficit on the trade account. It shows up in the sense that export jobs are falling. We're losing jobs abroad, if you will. But it also means that the supply of money, the reserves of money, are being also lost in an attempt to maintain the fixed exchange rates. So that the first effect in terms of loss of jobs is shown in the upper loop here, where we see an income contraction, which in turn leads to a reduction in import growth. And that has a correcting effect on the balance of payments deficit. The contraction in the money supply is seen on the lower loop, whereas the money supply or credit shrinks as we try to fix our exchange rate. That reduces the price level in the U.S. In turn, it means improved competitiveness because our goods are now cheaper relative, let's say, to German or Japanese goods. And because they're cheaper, they sell better, and so we get an improved export picture, and the flip side, a worsening import picture. So both of those, again, tend to correct the deficit on the trade account. So there's a sort of a self-corrective mechanism going on here. Similar, but sort of symmetrical situation, if we look at a balance of payments surplus, we get the opposite set of effects occurring. First, because exports are growing, export jobs are going to grow, more income. So that's the top part of the loop here. As income grows, we import more. That tends to correct the balance of payments surplus because imports tend to reduce that surplus. On the bottom part of the loop, as we incur a balance of payments surplus, money comes into the U.S., reserves come into the U.S. again in an attempt to keep that exchange rate fixed. So that means an acceleration of inflation in the U.S., which in turn means a deterioration of competitiveness, and that has two effects. It means imports are cheaper now, so more imports are bought, but exports are more expensive, so fewer exports are sold. Those two tend to correct the surplus. Now, it's important to point out that these adjustments in the real world don't always occur quickly or completely. So often, it requires a policy change to accelerate the movement. For example, an increase in taxes or a tightening up of money, the money supply through tighter credit policies would certainly help in this situation. What about a world in which exchange rates can actually float? Well, here the difference, the major difference, and a very important difference, is that whenever we run a balance of payments deficit or surplus, it gets reflected in the exchange rate. So in the first instance, we have a balance of payments deficit. This leads to a depreciation in the value of the currency, in our case the dollar. And that has, again, two effects. First, the depreciation improves our competitiveness. It makes our goods cheaper relative to foreign goods. And that tends to reduce imports from abroad and boost our exports, which again corrects the deficit. On the upper part of the loop, in this kind of a world, a currency depreciation tends to lead to potentially, not always, potentially lead to a rise in inflation and possibly a rise in interest rates, both of which act to slow down the economy, slow down income growth, which in turn slow down import growth, which again tend to correct the deficit. Slower imports means a smaller increase in the deficit and potentially a complete correction in the deficit. Again, quickly looking at the reverse case, what if we have a balance of payments surplus? Here the currency appreciates, becomes stronger. Again, two effects here. An appreciating currency tends to worsen our competitiveness because now our goods are more expensive worldwide relative to foreign goods, and that leads to increased imports because foreign goods are cheaper, reduced exports because our goods are more expensive, and this tends to correct the surplus, turns it more into a deficit, as it were. On the upper part of the loop here, currency appreciation tends to lower our inflation rate and interest rates. At least there's the potential that it can do that. It can bring, as a result of that, bring about a boost in GNP growth and income growth. Now, lower inflation, lower interest rates tend to boost growth, which in turn boost imports of foreign goods, which again tend to reduce the surplus in this case. Now let's look at what economic theories have been developed over the years to explain exchange rate movements and their interaction with balance of payments. We're going to look at four of them. This is not an exhaustive list, but at least it gives a representation of the kind of theories that have been developed. The first is the so-called trade or elasticities approach, where elasticity in this instance refers to the responsiveness of exports and imports to changes in the exchange rate. And basically what this theory says is the exchange rate will settle down or equilibrate, to use the jargon, at the point where imports and exports are in balance. Now, the failings, if you will, or the shortcomings of this theory are that, number one, it doesn't take into account capital flows, which are a very important ingredient of international transactions, certainly in the post-war period. But also this particular theory hasn't been very good in explaining why we've had very large swings in exchange rates in the 1980s or even before. A second theory that explains the movements in exchange rates is the purchasing power parity theory. It's a bit of a mouthful, but essentially what it does is it relates changes in the exchange rate to changes in prices. So to use an example, if inflation is growing at 4% in the US and only 2% in Germany, what this theory tells us is that the dollar will depreciate by the difference of those two. So 4% inflation in the US, 2% inflation in Germany would lead us to a depreciation of the dollar of 2%, which is the difference between the two inflation rates. A related theory is the so-called monetary approach to exchange rate movements, which takes it back one step further and relates exchange rate movements to changes in the money supply in the two countries. So again, let's go back to the German and the US example. If the money supply in the US is going up by 10%, but it's only going up by 5% in Germany, then you would expect the dollar to depreciate by the difference between the two, which is 5%. So a 10% money supply increase in the US, 5% in Germany leads to a 5% decline in the value of the dollar relative to the German Deutschmark. Now, these first three approaches to explaining foreign exchange movements are better at explaining the long-term changes that occur in exchange rates than they are about the short-term fluctuations that occur. So they're useful theories, but again, they tend to have a very long-term focus and don't always explain those short-term movements and fluctuations that occur month to month or even year to year. The last approach has been more promising in trying to round out the picture a little bit in terms of explaining these large fluctuations. It's called a portfolio balance approach. It not only encompasses movements in goods and services, but more importantly, it encompasses capital movements, which have become a very important ingredient in the world economy. And it explains how investors can move and shift their portfolio preferences from country to country as the interest rates change and as the exchange rate changes. So in that sense, it's a more comprehensive approach to exchange rate movements, and it really pulls in capital flows as well as goods and other kinds of factors. Let's see how we can use these theories to explain some of the events that have happened around the world over the last decade. And specifically, let's turn to our first case study, which looks at the financial crisis in Mexico in late 1994 and early 1995.
The 1982 financial crisis in Mexico was followed by the lost decade, which was marked by stagnant economies in Mexico and the other Latin American countries. The emergence of economic reforms and signing on to the North American free trade agreements in the early 90s started Mexico on the road to recovery. It was seen as a kind of poster child for development, for emerging market capitalism, for the idea that tremendous profits could be earned on investments in developing countries. Foreign investment capital poured into Mexico. Times were good. No one expected the next crisis, the crisis of 1994.
Mexican financial crisis was a tragedy. It was a tragedy of hubris. It was a tragedy of overconfidence. It was a tragedy of policy error that didn't need to happen.
Over the past 20 years, we've had about 5 major devaluations, or 5 major periods where just our balance of payments seems to be completely in disequilibrium, and we have to make major corrections in the economy. And as a result, we go into these big economic crises. In Mexico, we don't go into a recession, we go into a crisis, because the whole country seems to fall apart.
In a way, the crisis has also, of course, as is usually the case, not only economic elements in it, but very important political elements that are needed to put into the picture in order to understand what happened.
President since 1988 was Carlos Salinas. He started a large number of structural reforms that helped the economy, but it was far from complete. His party, the PRI, had been in power for 65 years, and in the upcoming 1994 elections, they intended to stay in power.
Well, the Salinas administration basically denied that there was going to be a crisis. The Salinas administration felt that it was all just a matter of providing confidence, and that if you just were confident enough and you asserted strongly enough that the exchange rate would hold, then it would.
We had a lot of capital inflows that were coming into Mexico because everybody was enthused with a lot of these changes that were occurring. However, a large amount of these capital inflows were short-term capital flows, some more speculative in nature, that could come in but could easily leave also. So that meant that while things did seem to be changing and did seem to be improving, a lot of it was more based on illusion than actual strong elements of recovery. Then 1994 came along, and a lot of things happened almost at the same time that made us keenly aware that the economy was much more fragile than we expected.
The first shock to hit the economy was on New Year's Day in 1994. A Zapatista uprising in the state of Chiapas. One of the reasons for the rebellion was their opposition to the signing of the NAFTA agreement. While the event did little to startle financial markets, it did shake investor confidence. Meanwhile, in the United States, repeated increases in U.S. interest rates lured many investors out of the Mexican markets into the more attractive U.S. market. And then, the greatest shock of all, Luis Donaldo Colosio, the presidential candidate of the ruling PRI party, was on the campaign trail. 2 gunmen put an end to his candidacy. It was hoped he would be the successor to Carlos Salinas. His murder, 2 other political assassinations, and a kidnapping helped set the stage for what has become known as the first financial crisis of the 21st century. Capital started flowing out of Mexico, rapidly depleting foreign exchange reserves from a little over $28 billion to a little over $17 billion, a net loss of over $10 billion in 1 month. With the election fast approaching, it was too politically risky to devalue the currency. The government tried to stem the flow of capital flight by issuing large amounts of debt in the form of tesobonos.
A tesobono was nothing more than a government debt in pesos, but with a protection clause against devaluation of the peso. So when things began to deteriorate in the Mexican economy and the political system, people began to change from securities denominated in pesos to tesobonos, anticipating the possibility of an exchange rate devaluation.
Nobody was quite sure if the Mexican government had enough foreign exchange to pay the amount of tesobonos that were outstanding. We owed something like about $30 billion in dollar-denominated treasury bills, and we had about maybe $3 billion in foreign reserves. So obviously everybody rushed to get in line so that their tesobonos would be the first ones to be paid, and they wouldn't lose their money.
Ernesto Zedillo, the new PRI party candidate, having won the presidential election, was under strong pressure to change economic policy. It was apparent that the peso needed a sharp correction, a devaluation.
At the Treasury, we had been following what happened in Mexico very closely. When I got the phone call at midnight indicating that they would be devaluing the next day, we were all very alarmed. We were alarmed because we were not sure there was a policy package in place that would provide credibility.
But the way that Ernesto Zedillo and his incoming administration handled this devaluation was very poorly done. For example, he met, along with his top economic advisors and top ministers, with a lot of leaders of the private sector to tell them that they were going to devalue the peso. The leaders of the private sector convinced him not to devalue, but just to have a correction of 15% in the exchange rate, instead of leading to having a devaluation. But then, by telling them that he was going to devalue, they just turned around and took their money out of the country, and that about $4.5 billion left the country in one single day.
As things turned out, they lost nearly half of their remaining reserves in the next several days, and ultimately were forced to create a situation where the peso would float.
So we had this total capital mobility. We wanted to have a fixed exchange rate, and we didn't allow domestic interest rate to jump as high as they should. So in the end, this impossible trinity set in, and as is usually the case, what gave in was the exchange rate, and the rest is history.
The sharp devaluation took the Mexican people by surprise. What followed was a period of complete economic chaos. Inflation and interest rates rose. Ordinary people saw their purchasing power fall by a quarter or more. Millions of people were unemployed. The value of Mexican assets on the stock market fell by 50% or more.
Almost all banks basically were on the brink of bankruptcy because nobody could pay their payments. And it wasn't one or two people who didn't want to pay. It was a collective society in general.
At the end of January 1995, the United States and the International Monetary Fund put together a $50 billion rescue package.
The United States and the international community moved promptly to focus on the restoration of confidence through the provision of finance based on strong conditions on economic policy. That was very different from policy in the 1980s that had put the principal focus on debt collection and on seeing how much resources could be extracted from Mexico. Mexico made serious policy commitments. Mexico contained its budget deficit. Mexico adjusted its interest rates. Mexico deregulated and opened up its economy, attracting foreign investment into key sectors. Mexico reformed its banking system. Mexico recognized its need to deepen its engagement with the world.
And our external debt levels have systematically reduced year over year, so that right now I don't think that Mexico is not even near any type of an external debt problem or a balance of payments problem like these that have plagued us in the past.
You know, Mexico faced a critical choice in 1995. It could have taken what happened as a signal to reverse course and go back to the Mexican economic model of the 50s and 60s. Or it could have taken what happened as a signal to redouble and recommit itself to reform. You know, I think the easier political course in those days would have been to have turned backwards. But the right course for Mexico, and the one that President Zedillo chose under the greatest of pressure, was the choice of moving forwards.
So how can we explain what was going on in Mexico and why investors lost confidence in Mexico? Some time ago, some of my colleagues got together in Melbourne, Australia to discuss this type of financial crisis. They include Richard Snape of Monash University in Australia, Hervé Torres of the International Monetary Fund, Magnus Blomstrom of the Stockholm School of Economics, and Rachel McCullough of Brandeis University. Let's see what they had to say.
Rachel, this case study shows an example of capital flight. Are there other examples when capital moves from one country to another that have less to do with panic?
Oh, definitely, yes. International capital flows are an important part of today's global economy and a force for greater efficiency. From the point of view of investors, capital is always moving in search of a better overall return. Now, that better overall return can reflect higher productivity of capital in one place rather than another, and that, of course, is the most healthy kind of capital flow. It can also reflect circumstances where different markets have different ups and downs, and then having an internationally diversified portfolio allows investors to get the same overall rate of return with a lower degree of risk. And of course, that's very attractive as well. In the case of capital flight, however, we view it as an unhealthy sign. It's not that the capital flight is by itself the bad thing, but rather it's a sign that the underlying circumstances in the economy experiencing the capital flight are not so healthy. And that's certainly the case that we see here.
Well, if you've got to the stage of flight, then it's obviously a failure of government policy somewhere that is causing that flight. On other cases, when you've got more normal capital flows, they'll be attracted into the country if there's a relatively good rate of return on the flow in. That is, if the interest rates are such that they can earn a return when you take account of the exchange risk in the future and so on, it will flow in. And typically, it will tend to flow from countries which have got good savers or high savers into countries which are, that is, relative to their own investment at home, to countries which are in fact investing a lot relative to their own saving. And so that, and often this will be associated with an age profile of a country. When a country is aging, it will tend to be spending more than it is currently producing, and it will be dissaving, and it will be calling on the savings that it's invested abroad. And when a country is relatively productive and relatively young and building up their assets, they'll tend to be investing in other countries. You'll have a flow of capital out of those countries, as Japan has been in recent decades. And you might expect in a few decades' time that there'll be a flow back to Japan as the people in Japan are tending to spend more than they're currently producing.
So would there be an argument in some cases to limit capital flow?
The experience of most countries is that efforts to limit capital flow, and especially to limit capital flight, can be extremely difficult to carry out. That could be the intent of countries, but the most effective way to limit capital outflow is to change the underlying policies and make the country an attractive place to keep one's money. In the case of Mexico, we can see that happening. When Mexico changed its policies, a lot of the flight capital came right back to finance new investments.
You know, also you can also say that the capital flight, in fact, forced Mexico to change policy.
That's
so
right.
it might have even have a positive effect on these countries.
And then you almost had a flight back into Mexico.
Yeah.
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 Richard, thank you.
Let's see if we can summarize what happened in this case study in the discussion. It's important to point out that both the capital flight and the decline in the value of the currency, the collapse of the peso, were symptoms of the underlying problems that were really the problems with the domestic policies in Mexico. It's important also to point out that Mexico was not the only country that suffered through this. If you look at the loans to developing countries in the 1990s in this graph, you can see a collapse in lending largely because many countries, Thailand, Indonesia, South Korea, Russia, Brazil, and Argentina, went through the same types of problems that Mexico did. Let's see if we can use some of our supply and demand diagrams to explain a little bit of what's going on in this example that we just saw. Here we have the foreign exchange market for the Mexican peso. On the vertical axis, we've got dollars per peso. That's the exchange rate. On the horizontal axis, we have billions of pesos. That's the volume in the foreign exchange markets. The supply curve, which slopes from the bottom left to the top right, reflects basically the supply of pesos in the world market, which comes about because Mexicans want to export goods, buy securities, and so forth, so that they pay with pesos or they exchange their pesos for other currencies. But nonetheless, they're putting pesos into the marketplace. They are supplying pesos. So that reflects those kinds of transactions. The demand for pesos is the line that goes from the top left to the bottom right here, the downward sloping graph. That illustrates the demand for pesos in the sense that people who want to buy goods from Mexico and pay the Mexicans in pesos. Obviously, they demand pesos for those payments, or companies that want to invest in Mexico will also demand pesos. They need pesos to pay for those investments. Now, what happened as a result of the capital flight that occurred in 1994 and 1995 in Mexico? The demand shifted. This is represented by the downward and leftward shift in the demand curve. And essentially what it means is that investors lost confidence in Mexico. They started to sell off their assets. They started to dump pesos because they were very worried. And so that meant they wanted fewer pesos and fewer peso-denominated assets. And so that represents this downward shift in the demand curve. And the net result of which was a depreciation in the value of the currency. You can see the value of the currency dropped here in this graph, so that the capital flight also resulted in a depreciation in the value of the peso. Now, what economic theories can help us understand some of what was going on here? And we'll highlight two of them. There are others that can be used, but let's highlight just two of them. The first is the monetary approach, which essentially signaled that in Mexico, the money supply was growing very rapidly. Inflation had gone up. By 1994, inflation was in the double digits. And this was largely because of very loose, very expansive monetary policy. And the difference between that, the excessive monetary policy, and the relatively stable monetary policy in the US then led to a very rapid depreciation in the value of the peso. Remember, in this view of the world, what matters is the difference between money supply growth rates in the two countries. Now, we can also appeal to the portfolio balance approach in trying to understand what went on in Mexico. Because, again, what was going on here was portfolio managers, investors, made a bet against Mexican assets. They decided that Mexican assets were a big risk. So they jumped out of Mexican assets of all kinds. Investments, stocks, bonds, all went to the US. And so as a result of that, their demand for those assets decreased. Their demand for pesos decreased. And that had the effect of depressing the value of the peso. Let's see how these same theories can explain our second case study, in which we had hyperinflation in Argentina.
Argentina, May 1989. This once proud, productive, vital country was considered having one of the strongest economies in the world. But a runaway inflation process has set its teeth into the height of the nation. With its currency in constant devaluation, its investment capital in flight, panic and chaos has ensued. The government was forced to declare a state of emergency. 60 years earlier, in mid-1929, no one could have imagined Argentina in such decline. One of the world's richest countries, its economy ranked 6th largest and was the most successful in Latin America. Argentina's rich farms and busy factories exported large volumes of wheat, meat, and other agro-industrial goods. Export earnings were strong, and so was the national currency, the peso. Then the Great Depression of the 1930s began. Bewildered, the nation's leaders tried to halt the advancing economic disaster at their nation's borders. They hoped to preserve prosperity at home by adopting a policy of import substitution. Instead, the economy crashed into ruin. Year after year, protectionism and the government's mistaken management of the economy increased. A large number of loose-money public enterprises, continuous salary increases not related to productivity, and a weak tax system made the government run a permanent and increasing fiscal deficit, which was combined with a loose monetary policy. One of the gravest symptoms of the enduring crisis was inflation. For 6 decades, Argentina's economic policymakers were virtually helpless to restrain rising prices. The unrelenting increases gained particular momentum and peaked as hyperinflation hit in 1989. That year saw staggering inflation rates of as much as 200% a month, unprecedented even for Argentina's bleak economic history. The man at the helm of Argentina's central bank was José Luis Machinea.
I would say Argentina was used to high-rate inflation. Between 1980 and 1985, we had an average inflation rate of 10% a month, and the country was used to it, therefore always somewhat exposed to hyperinflationary explosion.
In 40 years, it was the worst crisis we ever lived. Really incredible. The less you sold, the more money you made.
Our money is worth less every day, and our living standard too.
The financial burden on the government was punishing as well. With the peso losing value almost hourly, money to be raised tomorrow through taxes was certain to have less purchasing power than government funds spent today. This chronic inability to catch up with inflation deepened the government's deficit, which in turn gave yet another twist to the screw of the crisis. The steady devaluation of the peso led investors to convert their holdings into stronger currencies, and the capital fled Argentina in massive amounts. Not only banks and institutional investors, but ordinary citizens sought to conserve their purchasing power as well. Workers rushed to buy dollars and other foreign currencies the moment they received their pay in pesos. People unable to exchange their wages or salary for foreign money hurried to spend their pesos before it lost all value. With the annual inflation rate topping 6,000%, Argentinians bought anything available. Even perishable food had more staying power than the peso.
What a disaster.
It's really crazy.
It is the fall of the economic system. Simply that.
As the inflation-wrecked economy neared complete breakdown, only tangible goods had lasting value. This explains the shopkeepers' reluctance to sell and the frenzy of the crowds that stormed shops and supermarkets in 1989. In Buenos Aires, the capital, as well as in other cities, bands of despairing people roamed the streets of poorer districts, plundering what they could. In their effort to break inflation's assault on the battered peso, the monetary authorities decided to substantially increase the interest rates. But it was not enough. Roque Fernandez, the current head of the central bank, explains it was the only strategy they could use.
We used a strategy designed to cut down the vicious circle of higher interest rates Hard debt, bigger deficit being financed with the emission of money, which is the actual restructure of that same fiscal debt. Then the state, in a compulsory way, declares that all deposits in the financial system will be exchanged for a 10-year government bonus. And together with a full program to reform the state, getting started with the privatization process, reducing the expenditure of the public sector, it finally brought all that monetary disorder under control.
To salvage Argentina's economy, sweeping macroeconomic policy changes went into effect. The peso exchange rate was fixed. In this way, the government was obliged to maintain fiscal and monetary discipline. Otherwise, the national currency would soon become overvalued. As the exchange was fixed, inflation started to decline to the levels of Argentina's main commercial partners, and so did interest rates. Prices for goods and services provided by the state-owned companies are adjusted. Barriers to foreign investment are dropped. And peso bank accounts are frozen and converted into US dollars with a bonus. A vast program is also launched to sell off government-owned enterprises. All these free market reforms created confidence, both in the international community and with the national private entrepreneurs, as Ricardo Esteves, director of the Bunge and Born Group, explains.
For us, as entrepreneurs, as a part of society, we carry our own huge responsibility, which is maybe even greater than that of the official sector that already took its first steps. This means to answer the great challenge, to take on this big opportunity that unfolds. Our enterprises simply have to be successful in the world's context of today. This will be the ultimate test for the Argentinian private sector.
Hyperinflation was finally vanquished in 1991. From monthly increases in prices of as much as 200% in 1989, the inflation rate came down to 0.1% in December 1993. Today, Argentina continues to consolidate the gains of the past few years. After decades of stagnation, the gross domestic product grew 9% in 1991, the same rate in 1992, and 5% in 1993. Private investment is robust, and capital flowing from overseas has strongly revived the economy. Government monopolies in telecommunications, energy, and other industrial sectors have ended. In June 1993, the privatization of the state oil company alone brought in $3 billion, the single biggest stock issue in global investment history. It constitutes a dramatic turning point in the large history of poorly managed public enterprises. After decades of grim decline, Argentina has struggled back to price stability and reinvigorating growth. If the country's current economic success holds, hyperinflation may someday once again be as unimaginable as it was 60 years ago.
Let's go back to Melbourne, Australia, and see what my colleagues had to say about hyperinflation in Argentina.
Richard, what essentially is the link between inflation and a country's exchange rate?
Well, as usual, there can be links both ways in this, and so often in economics there's a linkage one way and then a linkage back again. If a country is having a rapid inflation, then it can be expected that its exchange rate will be depreciating, because as it's inflating, its products will be becoming less competitive in the world. It will tend to be importing more from the rest of the world, and that the rest of the world won't be buying the products of the country, so the demand for the country's currency will go down, and so the currency will depreciate. In turn, of course, that depreciation of the currency is going to make its import products more expensive for the consumers, and the consumers may in fact have wage earners, may have their wages, real wages, eroded by that increase in the prices of imported goods. They then may go along and demand higher wages to compensate for that. As the wages go up, then of course that's more inflation for the country, and the commodities become less competitive again, and so you can have an inflation, exchange rate depreciation, inflation spiral, a very nasty situation, which if it gets out of hand, can lead to hyperinflation.
Where does the interest rate situation come into this then in relation to domestic exchange rates?
Well, the interest rates that are paid to savers and charged to borrowers have to reflect people's expectations of inflation. So that if I'm happy with a 3% rate of return on my money, but I expect inflation to be 10% over the next year, then I need 10% just to stay where I am, and then the extra 3%. So we'd expect the interest rate to be 13% under those circumstances. And if the expected inflation rate is 100%, then we would need 103% in order to get a 3% rate of return after adjusting for the effect of inflation over the period of the year. Now, many countries, and especially developing countries, limit interest rates. They set a ceiling on the interest rate, and that may be a reason for savers to be unwilling to put their money into banks and to look for alternatives. For example, they may look to invest their money in real goods, like even food products, as a way of letting their savings keep their value over time. Or they may try to buy foreign exchange assets if they expect those to be more stable than the domestic currency.
But this sort of sparks a crisis, as it did in Argentina, and you really can have a currency crisis, and then hyperinflation, it just running away with you.
There's a point when you have to do something very drastically in order to regain confidence from everybody, from economic agents. In the case of Argentina, for example, nobody wanted to have national currency in their hands because that money kept losing its value.
It was useless eventually.
It was useless. Everybody wanted to get rid of it as soon as possible, buying food, buying foreign exchange, buying whatever. So the government needed to do something radical. What it did was to say, look, from now on, by law, the exchange rate is to be fixed, is to be pegged to the dollar. I'm going to assure you that from now on, 1 Austral will be equivalent to $1. Obviously, this is a very risky game, because if government doesn't adjust the global economy, if it doesn't pursue a sound macroeconomic policy, then what happens is that very soon it loses all its international reserves. For example, if the government is running a very important or large fiscal deficit, if it has a loose monetary policy, if there is a lot of money running in the economy, all that money is being converted to the foreign exchange, and if the exchange rate is fixed, then the government or the country is going to lose all its foreign reserves. So in the case of Argentina, as we have seen, that measure had to be accompanied, and in fact was accompanied by very other important structural reforms and other policy reforms, and this has been the ways in which they have been able to stabilize the economy.
Herbert, thank you very much.
So what is hyperinflation? By one definition, it's at least 50% inflation a month. Most of us in the US haven't experienced it, but what it means is that every day prices go up, the value of the money goes down, and it can create serious problems in an economy. Now, to be fair, Argentina was not the only country going through this. In fact, many of the other Latin American countries were also suffering hyperinflation: Bolivia, Peru, and Brazil. And in fact, other countries in the recent years have also been through a hyperinflation period. Eastern Europe and the former Soviet Union, after the collapse of communism, also suffered through periods of hyperinflation. And going back in history, Germany in the 1920s had a bad bout of hyperinflation, and there were stories of people going to the grocery store with barrels of money. Now, this experience has been deeply etched in the German psyche, And since then, Germans have been very conservative about inflation and have been very keen on having a very, very strong currency. But let's see if we can illustrate what happens in the case of hyperinflation by focusing on Bolivia. I'm going to show you some graphs which illustrate the kind of extreme experiences that can occur in hyperinflation. And what we see here is a graph that shows the money supply in Bolivia from April of 1984 to October of 1985. And look at the scale. This is a logarithmic scale, but it shows that, in fact, the money supply during this period rose by 17,000%. Now, what impact did this have on inflation? Well, it was fairly predictable. Inflation also rose dramatically during this period. It rose by 23,000% in this 1.5-year period. And you can see that on this graph, which is also a logarithmic scale. And finally, a fairly predictable impact on the value of the currency, here expressed as the number of pesos per dollar. It declined very dramatically. In this instance, the exchange rate fell by 25,000%. And so we can see it's a very extreme set of circumstances where the money supply led to a very high increase in prices, a very dramatic depreciation of the currency. Let's see if we can illustrate this graphically during this period. And this is, again, the supply and demand, but this time it's for Bolivian pesos. The graph here illustrates the supply curve, which is sloping upward here from the bottom left to the top right, and the demand curve, which slopes from the top left to the bottom right. On the vertical scale, we have the exchange rate, the dollars per peso, and on the horizontal scale, the volume of foreign exchange transactions in terms of trillions of pesos. And what we see is hyperinflation had a dramatic impact both on the supply side of this market and the demand side of this market. Because on the supply side, there were so many pesos in the world market now because of this hyperinflation, because of this very high growth in the money supply. There was a flood of pesos, basically. And that's reflected by this dramatic downward and rightward shift in the supply of pesos in the foreign exchange markets. On the demand side, basically investors couldn't wait to get out of peso-denominated assets, so they were selling their assets as quickly as they could. They were running away from Bolivia as fast as they could. So that is shown by this downward shift and leftward shift in the demand for pesos during this period, and the net result of which was a very dramatic decline in the value, the exchange rate of the peso, of the Bolivian peso, relative to the U.S. dollar, which we can see in this set of graphs here. Now, what of the various theories that we have talked about in terms of exchange rates help us to understand what was going on here? Clearly, one of the illuminating theories here is the purchasing power parity theory, because that one explains that differences in prices and inflation rates between the two countries clearly affect the value of the currency. And in this instance, when inflation was going up by some 23,000% in Bolivia, but only by about 5 or 6 in the U.S., you can understand the dramatic impact that that had on the exchange rate. Similarly, the monetary approach leads to the same conclusion. Money supply was going up 17,000% in Bolivia, but a much, much lower rate in the single digits in the U.S. So again, that led to the conclusion that the currency obviously had to decline by an equivalent difference there. And finally, the portfolio balance approach also sheds some light here, because what it tells us is that in this kind of an environment, when the value of assets is declining dramatically in a country like Bolivia, portfolio managers are going to run away from that country as fast as they can. And so, in fact, again, the portfolio shift occurred very quickly and dramatically away from Bolivia to other countries where the price level was more stable. Now, how do we pull this all together? What's the bottom line on these theories and their relationship to this important interaction between exchange rates and balance of payments? Well, the reality is both from a policy perspective and from an economic theory perspective, reconciling the big swings in balance of payments and foreign exchange rates have been difficult to do. They've been a challenge both theoretically and from a practical, real-life perspective. One thing is certain from the experience we've had so far, and that is that the eclectic approach, both to understanding balance of payments movements and exchange rate movements, and in terms of policy responses to both of those, is the best approach. And equally important is an approach that at least understands that the global economy is becoming increasingly integrated. For Inside the Global Economy, this is Nariman Barabash.
Annenberg Media. For information about this and other Annenberg Media programs, call 1-800-LEARNER and visit us at www.learner.org.